Hi, and welcome to the Assay. I'm pleased to be joined today by Warwick Grigor, Chairman at Far East Capital. So, Warwick, thanks for joining me here today.
Pleasure.
And so maybe before we dive into the actual interview, can you tell us a little bit about Far East Capital and your background within the space for those who don't know?
Yeah, sure. Well, I've been operating as an analyst in the equities market since 1982. In the 80s, principally with County NatWest, which was the leading broker at the time, and I was a specialist gold mining analyst in those days. Then the Far East Capital came about in 1991 when I left County NatWest to team up with Andrew Forrest to set up Far East Capital. That was a specialist corporate advisor, fundraiser, research house looking at the smaller developing mining sector. And basically, I've been in and out of Far East Capital ever since then. Andrew Forrest went off to become a billionaire with iron ore mines and things like that. So, I like to say I taught him everything he knows about mining. But then in 2008, Far East Capital sponsored the formation of BGF Equities with two young brokers down in Melbourne. And that was after 3 years, Canaccord paid 40 million for 50% of that. And as they say, the rest is history. I had to stay with the company for another 5 years. Then I went back to Far East Capital, which maintained its operating license, going back to what we were originally doing with the developing scene. But it was more a family office at that stage, investing Far East Capital's money, associate capital, and it's become, my role in that business has become more of a mentor at this stage of my career. But two notable things that I've done in that time as well was set up First Graphene, which has now been going for 10 years. That's the world's leading graphene specialist. And the other one more recently, I've become executive chairman of Agia Resources, which has got very high-grade gold in Colombia and phosphate in Brazil. I still do a lot of the research and the advisory and the mentoring, but with the state of the equity markets the way it is, I'm not really very interested in raising money for the junior mining sector when it's in such a state of depression. As I showed with Canaccord, I'm just as well equipped to be building businesses. And I see far more upside in building the Agia business. Eventually I might circle back to the equities markets a bit more deeply, but at the moment it's just not very productive.
Yeah, absolutely. I mean, it's such an interesting kind of history you have within the market. It's quite interesting to hear about. And so you are the perfect person, expert in the space, to talk a little bit about what's going on in the commodities markets today. So maybe you can talk a little bit about, what's piquing your interest right now?
Well, without doubt, it has to be gold. Just about everything else is depressed. You have a bit of a run in something like antimony and really specialist metals like that, but the volumes and the amount of money that you can make are, very limited. So gold is what it's all about at the moment, and I think we're seeing a change in the gold market that we haven't seen before. In the previous 40 odd years, gold would go for a run, the speculators would get in, traders would drive it up, and then in fairly sharp peaks, and then it'd spend an extended time period coming off the boil and really not very productive. It was the barbarian metal, according to the central banks. But today, in the last year in particular, there's something different. You're seeing a consistent rise in the gold market, but without getting terribly overblown at any one point in time. That, to me, suggests that there are parties in the gold market who want to accumulate gold, but they don't want the market to run away. They're not looking to trade as a short-term exercise. And, who would be doing that? Well, the most obvious party is China. As it becomes more persona non grata with a lot of the Western worlds, they're seeking greater independence from the financial systems, and that's where the gold comes into play. So I think it's not a position of speculators building up positions in gold. It's parties actually wanting to hold it and hold it for the longer term. So I really can't see anything better than gold at the moment. And when it comes to the junior companies, the important thing is that you can sell the gold the same day you produce it. All of these EV metals, all the new age metals, virtually everything else except for silver, you have to find a buyer. And so finding a buyer for, be it lithium, be it graphite, be it manganese, whatever, you've got to enter the supply chain, and you have to enter the markets that you're dealing with. All of these markets have been distorted by Chinese activity in recent years, and then most of them don't have a transparent terminal market like the LME. So for a junior company, it's wonderful to have a big ore body, and it might be great, good grade, but how are you going to sell the product? That's what so many of these junior companies don't realise. Gold is not a generic product in a particular geology. You get lots of different types of geology, lots of different grades and metallurgy. And so within that gold sector, you've got a whole range of projects that may or may not be economic and successful. But so long as you do your homework, there's many that will be. So gold is the most important one. Everything else, the EV battery input stocks, once upon a time, if you're in the lowest cost quartile, you could be deemed a very likely success in a mining operation. But as we've seen how the Chinese activity in markets have butchered prices, even being in that lowest cost quartile is not enough to guarantee success. So, we've seen commodities like copper, people say that's essential. And it is. But look how the copper prices performed this year. If it was that, it seems like whatever brokers or promoters are pushing, that's the order of the day. But that day might not turn into a month or 6 months or 12 months. So it's really quite a perilous time. I think silver's still good. Uranium is good too. It's got a good future. But you'll see over the last 12 months, the ETFs have been buying uranium. But before they've bought uranium, they've got the Sprott parties like that, good examples, where they will have been buying into uranium stocks. They then go into the market to buy the uranium. Everyone gets excited because the uranium price is going up. But the source of that strength is the ETF activity. And just when everyone's getting excited, the ETFs will be selling uranium stocks and cashing in. And the investors will just say, well, what was all that about? So we're seeing a lot of manipulation of markets by various players, and that just makes it difficult. That said, with the market so depressed and a lot of commodity prices down, it's at that stage of the cycle where you could probably buy a lot of these. And if you're prepared to wait 6 months or 12 months, you look back and say, wasn't that a great time to buy? It's just human psychology. People get most depressed when that's the best time to be buying. So, but, the evergreen one is still gold at the moment.
Yeah, absolutely. And so how are investors kind of looking at the gold markets? Is it buying, looking at the actual junior miners, physical gold, where are people most interested right now within that precious metal space?
Well, it's an interesting question because a lot of investors are not engaged as much as you would expect in gold, given everything I've just been saying. There are many different types of gold companies, and there are traps. We've seen it, for an example, Bellevue has got a very good gold mine in West Australia, but they've also done forward selling. Their hedge book is probably minus $250 million at the moment. And so when you would think that the gold producers would be doing very well at these gold prices, but you need to make sure that they haven't got these ugly forward selling positions. In terms of, there's a lot of gold companies that still are not seeing love. A lot of exploration companies are not seeing love from the investors. I think physical gold is something which is more of an insurance policy within your investment portfolio. You don't go excessively overweight in gold. If you want leverage to the gold price, go for those companies that are looking for, that have got projects with merit, that haven't forward sold. There's a lot of smaller companies out there that could make very good money. They might not be big mines, but with these gold prices, you don't need a lot. And with the equities market being so ugly for raising capital, the junior companies that are going to do best over the next few years are those that have got very good economics on the gold projects, small or large, that won't have to go back to the equities market and put up with the 30% discounts that a lot of brokers are imposing upon them if they go to raise capital. So generally, the investor's attitude towards gold is surprisingly disjointed. There's not a great wave of enthusiasm, and I think that's probably got a bit to do with lack of depth of management, general malaise given the way directors tend to look after themselves ahead of shareholders. I think there's still a lot of opportunity for the gold space. Choose your right. They don't have to be big. Get away from that concept that it needs to be a 100,000 ounce producer to be worthwhile investing in. 20,000 ounces a year at these prices, you can make a lot of money.
Absolutely. I mean, that leads quite well into my next question, which, what is it about a company or a junior miner that would make you want to invest? So what makes it stand out to you? And do you think your investment criteria can be different than some of your peers in the market?
My criteria, starting with that last question, my criteria is different because of my position in the industry. I'm not that much of a trader. I'm more of an analyst who will look at the bottom line. I professionally, and especially giving advice to people, it's not trading advice. It's more where the real value is. So I perhaps look at things, I would say, a little more responsibly in terms of market operations. The stock market is a casino, there's no doubt about it. And I recently gave a paper that said, do you want to know the real world or the fantasy world? The fantasy world is the hot money trading around. You can make a lot of money. The difficulty comes when you try and rationalize the fantasy world with the real world. And to make serious money, a stock like, say, Emerald Resources, that went from sub $1 to plus $4 over 4 years. You knew it was always going to happen because of the quality of the management and the resources. But not many people are prepared to wait around for 4 years, even for that terrific return on capital. So I do look at things a little differently. For many years, people have been saying, including myself, that management is 80% of the decision-making process. But more recently, I've added something on top of that. Good management is discipline, working hard, being responsible, and being capable. But there's another element that I think stock market investors need to consider, and that's leadership. Leadership, both of your operating staff, your company staff, but also investors. It brings all that management together, and it uses human psychology and skill to add the icing to the cake. And I think that good leadership is necessary for your investments to outperform the market rather than just move with the market. If the market trusts you, if they know you're capable, if shareholders know that you're working in their best interest, that's going to make you stand out from the pack. And I think the big problem with the smaller end of the market, directors are paying themselves, in most cases, at least twice as much as they're worth. You've got companies that are paying the CEOs 300,000 to 400,000 ounces per annum. That, if they're not producing a cash flow, if they're just exploring or pumping the market, that's just a direct wealth transfer from shareholders to directors. And really, we should try and put a stop to it. But human nature is such that they don't mind a lot of these punters in the casino we call the stock market, they don't mind running with the wolves or the thieves, whatever you want to call them, if those guys manage to run the share price. Now, it's not particularly responsible or meritorious investment, but people go in the stock market because they want to make money, and you can't hold it against them. It's just the way it works, and it is like a casino. But you've got, as an investor, you've got to decide what you want to play, whether you want to follow the Pied Piper, and just make sure you've got the seat at the table when the music stops. But the junior market, some people are saying that the model's broken. Well, it always seems to recover in time. We had so many IPOs come along that had absolute crap projects. They should never have been allowed to list, but they did. We've probably got to see 200 companies die before we get back to the core number of companies that investors are prepared to support. But and there's the other thing, as these companies look for people to buy their shares. The old model of stockbroking is finished. That's gone. Where brokers would actually broke the stock. They'd get paid a commission. They'd find buyers and sellers, and they'd talk the stories. There's a new type of entity out there called wealth management. And companies need to cuddle up with wealth managers directly rather than going through brokers. And they need to develop a rapport and a relationship of trust. The wealth managers, in theory, are more responsible than brokers were ever in advising on buying shares. The wealth management people have a greater level of relationship. It may or may not be fiduciary, but it's certainly stronger than your average stockbroker. If you get these people on board and you deliver, then you've got a friend for life. And that's really the business model. The wealth managers are a bit more conservative, and so they should be. And one of the other troubles with the junior end as well, excessive compliance. You've got the stock exchange with very complicated listing rules relating to mining companies. It's administered by lawyers, not practical market people. You've got geologists that work for the stock exchange, which have got very little, if any, experience with operating mines. And I think that all leads to an artificial world which just makes it so expensive to comply with. There's not a lot of sense. The stock exchange is becoming more of not a regulator, but a dictator. There's so many companies that want to get an announcement out to the stock exchange because that's part of the continuing disclosure legal requirements. But you see many examples of the stock exchange sitting on these releases for days, if not weeks, which makes a joke of continuous disclosure. So there's certainly over-regulation to no benefit of anyone. It's a lawyer's ticking boxes exercise that has only partial relevance to the real world. So I think that, we're actually getting to the stage where we need a different sort of market, a junior market, which is less driven by lawyers, where ASIC or the eventual overreaching body needs to say, well, all right, if you go into this market, it's cowboy country. We're not going to go out of our way to protect investors. There'll be some basic regulation, but we need to reduce the costs for so many of these companies just staying alive. And money needs to be spent in the ground, not on lawyers. So there's plenty of precedents for a venture market, a higher risk market. But let's not try and make these mining stocks and exploration stocks appear as if mums and dads should be investing in them. They never were. They never should be. Over-regulation is just a nightmare. If people want to have a punt, let them have a punt.
Yeah, it's quite interesting. I mean, it's kind of it does sound like the regulatory constraints might be kind of I suppose overreaching in terms of allowing the market to grow.
And in that regard, one of the things I do with my newsletter and my advice I give people, it's educational. It doesn't just say go out and buy this or that. I rarely say that. I point out aspects of the market that people should be aware of. I try and make sure they get the real story. Maybe there's a need for something that sets standards that companies should adhere to, but without the threat of going to jail behind it. And I'm in favour of more self-regulation within industry without the need for lawyers. We need to perhaps have a body which says this is how you should behave. And if people go outside of the boundaries and behave badly, well, there should be an ability for that body to expose them, but more so that people know what's going on than, oh, we're going to get you and throw you in jail. Self-regulation is always much better than, excessive legislation. I'm very simple. When I decide to do something, my first thought is, does it offend the 10 Commandments? Nowadays, when I was a child, you did whatever you wanted to do so long as it was morally right and didn't offend the 10 Commandments. Nowadays, we've got so used to over-regulation and rules and laws that we've lost the nexus between common sense and behaviour. And the first thing companies do is run to a lawyer. Is there a law against it? And better industry regulation, ethics or moral emphasis is going to lead to a better outcome without the frustration of paying lawyers by the hour.
Absolutely. No, it's quite interesting to kind of hear your thoughts on that. And I suppose, my last question was really just, looking forward. So any kind of market trends that you think, investors should be on the lookout for, where do you think things are going to be moving within the next year or so?
Well, I already see some green shoots coming through. There is money being made on select stories. It's all about not really following a trend at the moment. It's being stock specific. It's reacting to news flow. I see that the punters are coming back into the market because there's a feeling that we have bottomed, but coming off the bottom's not going to be universal. I think obviously getting back to gold, but I think that the investors need to make sure that whoever they're backing have promotional skills as well, leadership skills. They need to be able to raise money, but that's sort of pretty basic. There are just so many companies out there with what they call stale bulls. They've ridden stocks down to 10% of their original value, and there's a lot of people that are looking for those share prices to rise so they can get out, not losing as much as they might have been recently. But everyone's in that same boat. Interest rates, they look as if they're peaking. That'll have some impact because the original bear market was induced as much as anything through interest rates going up. Commodity prices came down. I think China is still a worry. What are they really doing? We're not getting reliable information on China anymore. They are still the biggest consumers of just about every commodity, and they want to be the biggest producers as well. But it's all getting a little bit dysfunctional at the moment. I can see the market wants to go higher at the moment, but selectively. A lot of the dogs will be left behind, and the investors really just have to decide where's the enthusiasm, where's the momentum, where's it smart. Stay away from those companies that have got nothing, that they might have $2 or $3 million in the bank, but that quickly disappears under just staying alive. So be very careful of that. The same old rules of principal rules of investing remain, but the market has bottomed, the bottom end. You may go and buy. You need to look for stocks that will be responsive to new buying coming in. That's one of the key points. Now we've seen the worst of it, but we're not going to be making a lot of green grass straight away.
Hopefully, things turn around. I think it's good to be kind of focusing on the commodities that are doing well, as you mentioned, and keeping our eyes out. So, Warwick, those were all my questions today. So I want to thank you for joining me here at the Assay, and I definitely look forward to seeing you in person in London. And yeah, thank you.
Okay, thanks very much, Amy.